the first thing that you have to understand about exercising options is that this is first and foremost an investment decision. So going back to that discussion around, are we bullish on this company? You're not going to exercise your options unless you have a high degree of confidence that this company is going to succeed and be worth more than it is today in the future. So first and foremost is, do we believe in the future of the company? Second is, because options actually cost you something, there's an opportunity cost to buying your options. This can get very expensive.
Welcome to Real Money, Real Life, the podcast where we get real about money and the messy human stuff that comes with it. I'm Linda Grizely, financial educator and your Me Money guide to financial clarity. Each week, we dive into financial concepts and money strategies, but we always tie it back to real life, emotions, mindset, and how money actually shows up day to day. If you're ready for practical tools, mindset shifts, and honest conversations that meet you where you are, not where the world thinks you should be, you're in the right place. Because you deserve to feel confident with your money and good about how you use it. No judgment, no lectures, and definitely no putting yourself last. Hello, real ones. If you're listening, you are ready to stop guessing about equity compensation and start making those shares work for your future. Today, we're talking about equity compensation, those stock options, RSUs and grants, ISOs, all those acronyms that are hard to understand. They can look like golden tickets, but come wrapped in a tangle of tax rules, vesting schedules, and tough choices. My guest has made it his mission to guide professionals through the maze of helping them see not just the financial side, but how these decisions fit into the bigger picture of life, career, and freedom. Josh Radman is our guest today, and his journey into financial planning was different than many. He started in tech, where he received equity grants as part of his compensation package shortly after graduating from business school at Harvard. What was meant to be an exciting ownership opportunity quickly became a confusing tangle. When Josh looked for an advisor who could help him navigate these decisions, he found options lacking, and that led him to launch his own firm, Presidio Advisors. Today, Josh specializes in guiding people through the maze of equity comp, tax planning, and broader financial independence strategies. His approach especially resonates with younger professionals because it blends technical expertise with an understanding of the unique pressures and aspirations of his generation. For example, he doesn't just focus on whether clients should hold or sell their stock options. He ties those decisions to bigger questions about lifestyle, career transitions, and risk tolerance. This perspective makes him not just a financial planner, but also a partner in helping clients align their money decisions with their broader life goals. Now based in Denver, but serving clients across the U.S., Josh has built Presidio Advisors into a firm that fills a critical gap for young professionals in tech and beyond. Welcome, Josh.
Thank you. I am happy to be here, Linda.
Yeah, I'm so happy to have you because I know even as a financial planner, in talking about all these different things, ISOs, NSOs, RSUs, ESPPs, there's so many acronyms and they can be so confusing about how they work. So I know in your bio there we already had a little bit of your experience and why and how you got where you are. But go ahead and tell us more about your story and fill in some gaps for us.
Yeah, so I actually started in tech myself. You mentioned that. And I was at a very large firm that rhymes with Small Mart. And they gave me that was my first foray into RSUs. And then I went to the other end of this spectrum and I joined a Series A company where I had my first equity grants of stock options. And those are very different. And, initially it's very exciting to have equity stakes in some of these companies. You have ownership, you're building products towards some of these great companies. You want them to succeed. And, I still want them to succeed too. But it's really hard to strategize around them. And so I had reached out to a couple of peers, super smart mathy friends, and even they didn't have a good understanding of some of the tax implications of what happens if I exercise my incentive stock options, or what happens if I sell my RSUs right as they vest. Should I keep them longer? And so there were all these questions in my mind around the strategy of what I should be doing with my equity grants. And like you said, I had a hard time finding somebody who I could relate to as a millennial and who really specialized in some of these niche equity offerings. And so that was my epiphany moment of, oh my gosh, I need to do something about this. There's a need here. And I experienced it firsthand myself. That led me to launch Presidio Advisors. I had always been interested in personal finance. This was just kind of the aha moment where I thought, you know what, I'm going to get really deep into this. And that started a few years ago. And then since then, I've gone into getting my CFP and my enrolled agent designation, which allows me to provide tax advice, because I think tax advice and financial planning, especially when it comes to equity compensation, go pretty hand in hand.
Yeah, absolutely. All right. So let's start with Equity Comp 101. Tell us about the most common types and what the differences are.
Yes. Depends on if you're at a private company or a public company. And then if you're at a private company, it typically depends on the stage that the private company is at. So let's start with the public company. That's typically easier to understand. Most public companies are going to grant you RSUs. Those are restricted stock units. They typically vest over a certain amount of time, let's say 4 years, and you get 25% of that grant vesting every year. So with a 1-year cliff, what does that mean? That means that you're not going to receive anything if you leave the company before 1 year, but at 1 year, maybe you receive 25% of your equity package. And then at the end of year 2 or somewhere in between, they start to vest monthly, quarterly, annually. So by the end of 4 years, you have fully vested into your equity grant, and then you can either hold or sell or do something with those RSUs, those restricted stock units. Then there are the private company equity awards, and these are a lot more confusing and tough to strategize around because there isn't a liquid market, and you often have to buy out your equity, right? So with RSUs, you are actually getting something. You don't have to purchase them. But in private companies, you are typically granted what's known as an incentive stock option, an ISO, or a non-qualified stock option, which is an NSO. Those are probably the two most common. If you get later down the line, you might get RSUs, but they have some nuances. With options, ISOs and NSOs, these are options, meaning they are the right to buy, but not the obligation to buy. So you can decide, hey, yes, I do want to have ownership in my company, in which case you have to purchase the options from your company, but you don't have to. You could say, you know what, I really enjoyed this experience, but I'm not super bullish in the company. And so I don't want to make that investment in purchasing the options in the hopes that they are going to appreciate further or appreciate more in the future. So ISOs, NSOs, RSUs, typically that's the main bunch right there.
Great. Okay. So you mentioned the word bullish, and because I want to keep this simple for people that are listening that aren't familiar with that term, can you go ahead and explain what bullish means?
I would say you are bullish if you are excited about the future of the company and you think that the company is going to be worth more tomorrow than it is today. And if that is the case, then maybe there is a case to be made to purchase your options at presumably a lower price in the hopes of selling them at a higher price down the line.
Great. Perfect description there. Okay. So now that we kind of know what those things are, RSUs, ISOs, and NSOs, tell us about what vesting means.
Yes. So vesting basically just means that you are going to earn these shares or these options over either a period of time or based on a performance metric. Typically, the most common is time-based, meaning you are in your role and they are going to vest over 4 years. And like I said earlier, every month or quarter or year, you automatically earn an amount of that equity, and that is an incentive for you to stay longer at the company. And so it's, if you stay here for longer, if you contribute more, then we are going to reward you in the form of these vested options or vested RSUs. A simple analogy would be, particularly at a public company, an RSU is essentially a bonus, but in the form of a restricted stock or a stock award. And so the company is rewarding you with this bonus in the form of stock for being at the company for a certain amount of time. And obviously, if the company continues to do well, that bonus will increase in value. And it's the same thing with options. To a lesser extent, there are a few nuances that are quite complicated, but that's kind of the high level gist.
Great. Okay. So we talked about what they are and how they vest, but what does exercising the options mean?
Yeah, exercising essentially just means that you are buying the options, right? So when somebody says, hey, I'm exercising my right to buy this option, it means, okay, I had this right. It wasn't an obligation of mine to use it, but I have decided that I am going to, and I'm going to buy this option, and you are going to have to pay for that option. So, for example, the company gives you options at a price of $1. If you want to exercise your options and you have 100 of them, you're going to have to pay the company $100 to exercise your options. We're not talking about taxes right now.
Right. Okay. All right. So now when people come to you and they have options and they're figuring out what they want to do with them, how do you help them decide whether it's time to exercise them? How do you help them understand their vesting? Tell me how that plays into your financial planning picture when you're talking to your clients.
Yes. So the first thing that you have to understand about exercising options is that this is first and foremost an investment decision. So going back to that discussion around, are we bullish on this company? You're not going to exercise your options unless you have a high degree of confidence that this company is going to succeed and be worth more than it is today in the future. So first and foremost is, do we believe in the future of the company? Second is, because options actually cost you something, there's an opportunity cost to buying your options. This can get very expensive. So for example, if you have 100,000 options all at $1 a piece, it's going to cost you $100,000 to buy those options. Now, they may right now be worth $4 a piece, $400,000, but typically these options are in private companies. There's no liquid market. So yes, right now it's worth $400,000 on paper, but we don't know necessarily if it's going to be worth $800,000 or $0 down the road. Valuations can change. And because we're dealing with private company equity that is not liquid or typically very illiquid, then we have to consider that. Now, on the opportunity cost side, $100,000, maybe to some person, and I'm envious of this person, that's not a lot of money. But to most people, that's a good chunk of change. And so you have to think about, what else would I use that $100,000 for today? And am I okay with giving that up so that I can purchase these options in the hopes that it becomes more in the future? Maybe you want to buy a down payment, or you want to put a down payment on a house. Maybe you're looking to buy a car, or maybe you have, high daycare expenses that are coming up and the cash flows aren't going to line up. And so you could really use this $100,000 in savings to cover the cost of daycare. That's a real opportunity cost that people need to think about and be content with, because you're trading something that is for sure you can use for something that is illiquid, tied up. We don't know what the value is going to be. And so that is could be a tough decision. And the last thing I'll say is the framework that I typically suggest people look at, or the framework that we explore together, is around regret minimization. What does that mean? What would we regret more in the future if we didn't exercise our options and the value skyrocketed, but we were able to put that down payment on a house? Or if we did exercise the options, we gave up the opportunity to put the down payment on the house and the valuation collapsed and it went to zero. These are very personal decisions. There's no one right or wrong answer. This is where working with somebody who has a good understanding of not only the company, the type of equity, but also your risk tolerance, your risk capacity, what is important to you in life. All of these things mesh together to help us come to a decision so that we can look back in 12 or 24 months and say, you know what, with the information that I had at that time, I made the right decision. Even if the outcome wasn't how I expected it to be, I felt good about how I, thought through that decision making.
Yeah, I like looking at it through that lens. And tell me again what you called it, where you're looking at which one is the worst.
Regret minimization, I think, is what
Regret.
yeah,
Yes,
like what are we going to
regret.
regret more or what are we going to regret less? Hindsight's going to be 2020. We know that. There's going to be some regret. We just want to minimize it. And that's the best that we can do.
I love that. Yeah, great perspective. Okay, what else do you think that people need to know before we move on to some other things? But just I want to keep you talking before I just keep asking questions if there's anything you need to fill in.
That's the high level. It's obviously a lot more in depth, particularly when it comes to taxation. And I think this is where people get really confused. And I definitely don't want to go down too many rabbit holes together with you. But there's more than just the cost to buy. So that's where working with an expert in equity compensation can be beneficial in that they can help you understand what is the total all-in cost, the opportunity cost potentially, the cost to exercise, and the tax implication, because you don't want to be caught red-handed, come April of next year and the IRS says, oh, you have an AMT bill. And you're like, what is AMT? AMT, alternative minimum tax. We don't have to talk about that, but there are considerations to be aware of.
Yeah, definitely. Okay. So let's talk about the how you connect these to bigger career or lifestyle goals. So you gave the analogy of the house, so that was a great one. But what about career-wise? What if you're not sure you're going to be at this company? Like, how does that play into a decision whether to do the exercise stock option?
The exercise, yeah. So there's a lot of considerations. I generally start when I work with people. I start with a pretty in-depth onboarding process because I want to understand some of these things. So, for example, are you thinking about leaving your company early? If so, there are implications there because typically there is a condensed window of, let's call it 90 days, which is the average, for you to make a decision to exercise your vested options, particularly in private companies, or you forfeit it entirely. And even though you're totally vested, you would think that, oh, I'll be able to keep my options forever. Not the case most often. And so, particularly if you're thinking about leaving your company, this could be a big impending decision. And I want to know about that up front. I also ask people about, like, what are we actually optimizing for? Obviously, we want to pay the least amount in taxes. But really it's more about, like, okay, do we want a life of meaningful and inspiring work? Do we want to spend more time with family and friends? Do we want more space to breathe? Do we want, a life that's more aligned with our value and sense of purpose? These are deeper questions, but they have implications around what do we do with the equity that we have, because particularly if it's worth a lot right now, then we need to think about what would we do right now if that money was in our bank account, and how would that enable us to achieve some of our goals. So all of this is to say, it's really important to frame this not around the taxation component, but around what's important to you. What are you hoping to achieve, attain, and what are some of the goals that you have in the short term, in the next year or so, in the next 2 to 5 years, and over the long run, and how does this equity component potentially help us achieve some of those goals?
Great. And how do you work in the stock from the company into their overall portfolio? I mean, do you make sure that they're not just putting everything into this one company's bucket, and how are you making sure that that's not you're not holding too much in the one company?
Yeah. So, this comes down to risk tolerance, which is an emotional kind of gut feeling of how well can you sleep at night, knowing that you've put all your eggs in one basket. And maybe that basket turns out to be the next NVIDIA. Statistically, it won't. I'll tell you that, but maybe it will. And then there's the risk capacity, which is more a quantitative understanding of how much can you actually afford to lose. And if you did put all of your eggs in this one basket and the basket was lost, so to speak, how would that impact you? How would that impact your ability to provide for your family, to accomplish some of the other things that you are looking to accomplish? So, again, we think about this as a piece of the broader puzzle. And if I can elaborate that real quickly, and I'm sorry, I like to talk, so I will just keep talking away here. But
Exactly.
I think about financial planning as almost like a jigsaw puzzle. Somebody shared with this analogy with me, and I just think it resonates so much. The first thing that you do when you open a jigsaw puzzle, other than finding all the corner and edge pieces, is you look at the picture on the top of the box, right? You can't know what to do with all those pieces if you don't know what picture you're trying to build. And the same is true in financial planning. We are on a mission to understand what is the picture on the box top of your life. Because if we don't know what that complete picture looks like, then we're starting to make these arbitrary choices about these individual puzzle pieces. And the equity compensation is one of those puzzle pieces. So it can feel super random and frustrating if we're just buying stock options, but we don't really know how that fits into the broader puzzle. And that's why I think it's so important to look at this big picture, to have this coherent plan, and then everything else starts to build on top of that. And, it's kind of a sense of relief because it's like, yes, we know exactly why we're making this decision. It may not pay off in the way that we want, but this is the bet that we're making and we're okay. And we've looked at all the different potential outcomes. So my job is really to help you understand the potential outcomes and the trade-offs of each.
Great. All right. So I always like to ask about the mindsets and internal obstacles that people come in when they're working with their equity comps. So, for instance, do people not exercise it or not do anything with it because they don't understand it and it's just too complicated? Do they just do it all and get themselves in trouble because they don't know what they're doing, even though they're just doing it all? Tell me about the kinds of things that you see commonly.
Yes, I think I work with a lot of folks who have just been paralyzed, honestly, for fear of making a suboptimal decision. And that is real. We don't really know the implications. Nobody teaches you about options or equity comp. I don't care if you have an MBA from the most prestigious school. Like, that stuff is not taught. So nobody knows what this is. It feels like there's a lot of information asymmetry. The company is telling you what this is, and you're just kind of saying, okay, thanks. Like, is that good? I think in terms of like mindset traps, not asking the right questions when negotiating or trying to understand what your equity comp is actually worth is a big one. And we don't ask the right questions because we don't know what questions to ask. So trying to working with somebody to help you understand what should I even be asking about my equity comp is an important one. And that could be like, well, what type of options am I receiving? Are they the RSUs or NSOs or ISOs? What is my equity as a percentage of fully diluted shares outstanding? That's a lot for people, right? But I can help folks understand what that means, and then once we have that, or anyone for any advisor, once you have that as a percentage, then you can actually benchmark that to industry averages to understand, okay, is this a competitive offer, or should I be asking for more, or does this skew on the high end, that type of stuff. So, those are questions that people should ask. People assume, I think, too often that the valuation of the company is always going to go up. It doesn't. People assume that there's always going to be some sort of liquidity event. There is not, or that the IPO is always going to happen because the company's been talking about it for the past 4 years. They get pulled all the time. So there are things to be aware of and risks that you may not be able to see around the corner, but somebody who has seen this many times can help you understand.
Yeah, for sure. Okay, so if someone's listening and they're thinking, I have stock options, I don't know anything about them, I haven't done anything with them because they're scary to me, or I just, I don't have time to figure it all out. What would be the first step they would take to get clarity on what their equity package is?
Okay, so one step that they could take would be look at the wherever your equity is held. So Carta is a frequent platform, ShareWorks, Charles Schwab. Try to find out what kind of equity do you even have. And so I think that's probably the first step. And then, most advisors are willing to give 30 minutes to just chat, very high level. Hey, I'm in kind of this position. I've never really thought about that. Can you just help me understand what I have and what I should be thinking about, and maybe what questions I should be asking myself or questions I should be asking to my company? I know I'm always open to that. I like helping people. That's why I got into this business. Is I get up every morning because I've developed really great relationships with my clients, and I like helping folks. And so I'm always happy to lend 30 minutes, and I think most other advisors are too. So reach out to somebody, like just ask for 30 minutes of time, and I think that can go a long way.
Absolutely. All right. And one thing they can stop worrying about that doesn't matter as much as they think.
What investors actually paid for the shares, because you have a totally different type of share. So you may see that, this venture capital firm paid $45 a share. Not to get too tactical, but they paid for a preferred share price. It has different rights associated with it. You, as an employee, have a common shareholder, have a common stock that is probably worth about a third or a fourth of that. The preferred price, for all intents and purposes, doesn't matter at all. The only thing that matters is what's known as the 409A valuation, or the fair market value of your common stock. If you look into your account, your Carta account, or if it's a public company, the price at which it's trading for, that's what matters. But for private company folks, don't even worry about what the investors paid for it. Don't worry about the preferred price. That may be too much, but
that's all right.
To mind.
How would they know what the value is of what they're buying?
Yeah. So for private company folks, if you log into your account, you are going to typically see something in the upper right-hand corner that says, hey, the 409A, or the FMV, the fair market value, is $2.35 a share. So that's how much it's worth today on paper. That doesn't mean that it's going to be worth that much when you actually sell it. Could be worth more, could be worth less. You take that, you multiply it by the number of shares that you have, and that is your gross equity value. But don't get too hung up on that number, because valuations change at least every year.
Makes sense. All right. If there was one big takeaway that you wanted the listeners to remember about equity compensation, what would that be?
I'm going to focus this particularly for those who are at private companies. A little bit different with public company employees if you already have liquid equity. But for private company employees, I would say your equity is really a lottery ticket. I wouldn't bank on it. Don't join a startup because of it. Don't join any company because of the equity. But if you are fortunate enough to cash out, remember that fewer than 5% of startups ever get that opportunity. So be grateful for it. But there are still many, many, many great reasons to join startups. There are so many lessons to be learned, shoulders to be rubbed against, teams to lead, things to break. And so there are great reasons to join a startup. But I would say the equity component is probably shouldn't be the number one reason for it. Do it for all the other learnings that you're going to have and the people you're going to meet. That would be my thought.
Great advice. Okay. Is there anything else that you feel like people need to know as to top level talk about this, about equity comp?
I would just say it's confusing. It's a lot. Nobody teaches you about this. Don't be embarrassed about it, because everybody else is in the same boat, regardless of what they tell you. They have no idea what really they should be doing. And so you're not alone when it comes to this. It's the reason why I started this company in the first place is because I realized, wait a second, everybody else is in the same camp. And often the companies, they don't even want to touch taxation with a 10-foot pole. They don't want to get anywhere near that because they don't want to be thought of as giving tax advice. And so don't be afraid to ask questions and know that everybody else is trying to figure this out with you.
Great. Thanks so much for that. All right. Who needs to find you? Obviously, anybody that has equity comp that has questions, but who else needs to find you at Presidio Advisors?
If you're a millennial who is looking for, more holistic financial planning, you have maybe an equity component, but that's not all of it, right? We're going through life together. We're starting to have kids, and we're starting to think about, things are getting more complicated. That is why most of my clients end up staying around for the long term, because life is starting to get complex, and there's a headspace premium to be generated if we can outsource this to somebody who we as a client can trust and can be more efficient and effective, so that we can spend more time with our kids on the weekends and taking up mind share in things that actually matter to us. So I think if you are of the delegator type who wants to focus on more important things in life than trying to figure out your equity comp and taxation, or just feeling overwhelmed in general, I'd be happy to chat.
Great. And where can they find you?
My website is presidioadvisorsllc.com, or they can find me on LinkedIn, Josh Radman, Radman.
Great. Thanks so much for joining me today, Josh. Appreciate all of your knowledge. Yes. And here's my quick nugget from this episode. Equity compensation doesn't have to be confusing. When you connect the numbers to your actual goals, you turn stock into strategy and strategy into freedom. And finding a partner that can help you make sense of it is probably key to that. So thank you for joining us today. And I look forward to seeing all you real ones next time. Thanks so much for listening to Real Money, Real Life. Want to see what's blocking you from financial confidence or discover your money personality? Head to the resources page at lindagriz.com for our free quizzes. That's LINDAGRIZ.com/resources. If you're loving what you're learning, be sure to subscribe and leave a review. I'm your Me Money Guide to Financial Clarity, Linda Grizely, and I'll catch you next time as we talk more real money, real life, because you deserve to feel confident with your money and good about how you spend it. The content shared here is for educational and entertainment purposes only. It is not financial, tax, legal, or planning advice and does not constitute therapy or mental health counseling. Please consult an actively licensed and qualified professional for advice or help specific to your situation.